Silver tagged $80. Then it didn't pull back. It collapsed. From $80 down into the low 70s like someone cut the rope. And while that candle was printing, thousands of accounts were being closed. Not by choice, by force. Margin calls don't ask permission, they execute. By the time most people woke up and checked their screens, the damage was already done. Positions gone, equity erased, confidence shattered. That wasn't a correction, that was a transfer. And if you don't understand why it happened, you're going to donate again the next time the market decides to teach the same lesson. So let's talk about what actually happened. Not the headline, not the narrative, the mechanism, because when we understand the mechanism, we stop being victims. We start being observers. And observers survive. First, we need to say the quiet part out loud. The $80 level wasn't just a number. It was infrastructure. Round numbers in commodities aren't random resistance. They're magnetic. They attract option strikes. They attract stop placement. They attract narrative. When price approaches a round number, an entire ecosystem of behavior activates around it. Some traders sell because they believe it won't break. Some traders buy because they want the breakout. Dealers hedge because they don't want directional exposure. Algorithms trigger because they're programmed to trigger. And all of that activity stacks into what looks like a wall. A thick layer of supply defending the level, a barrier that feels real. But here's what most people miss. That wall is not a fortress. It's a position, and positions can become traps. The wall didn't hold. Silver pushed through $80, and the moment it did, something changed. The sellers who were leaning on that level, expecting it to hold, suddenly had a problem. Their short positions were underwater. Their stops were getting triggered. Their hedges needed adjustment. And the buyers who had been waiting for confirmation, they piled in. Momentum systems activated, breakout traders jumped, and dealers who had sold call options at $80 were suddenly forced to hedge by buying more futures. That's reflex. That's how a breakout accelerates, not because everyone believes, because the mechanics force participation. So price didn't drift through $80. It launched, and that launch felt like victory. It felt like confirmation. It felt like the thesis was finally being validated. But here's the part nobody talks about when the champagne is popping. The same mechanics that create explosive breakouts also create explosive reversals, because leverage works in both directions, and the market was about to prove it. Now watch this. When a market goes vertical, the system doesn't sit there and admire it. The system responds. Clearinghouses look at volatility, they look at daily ranges, they look at risk. And when risk expands, they raise margin requirements. That's not manipulate. That's how leverage markets regulate themselves. But here's what that means in practice. Positions that were adequately margined yesterday are suddenly undercapped today. Traders who thought they had enough cushion wake up to margin calls. And margin calls don't negotiate, they liquidate. So the same move that made people feel rich at $80 made them insolvent by $74, not because they were wrong about the direction, because they were wrong about their exposure. And that's the brutal truth most people refuse to accept. You can be right about the thesis and still get destroyed by the path. The path is not a detail. The path is where the money is made or lost. And in silver, the path is violent. Here's what the crowd never sees: the plumbing. In a liquidation cascade, price isn't discovering value. Price is hunting collateral. Think of the market like a dam. When leverage builds up behind it, everything looks stable. Calm candles, smooth progression, quiet confidence. Then one crack forms, and the water doesn't flow. It explodes. That explosion is forced market orders hitting a thin order book. That's why it feels like gravity turns off. That's why slippage appears out of nowhere. That's why your perfect stop loss becomes a myth. You set it at $78. You got filled at $75. And you're sitting there wondering what happened. What happened is simple. When everyone is selling at once, there's no one to buy at your price. The bid disappears, and market orders fall through the book until they find liquidity. Sometimes that liquidity is $5 lower. Sometimes it's 10. And by the time equilibrium returns, you're already out. Not because you chose to be out, because the system pushed you out, backed. Silver fell from $80 to the low 70s. Interpretation: the move was designed to force decisions under stress, because stress creates mistakes, and mistakes create supply. Supply that gets absorbed by someone else, someone who wasn't panicking, someone who was waiting. And that's where the real pressure starts. Now we need to separate two things that look identical on a chart, but are completely different in meaning: fear selling and forced selling. Fear selling is emotional. It's discretion. It's someone looking at a red candle and deciding they can't take the pain anymore. Forced selling is mechanical. It's involuntary. It's someone getting liquidated because their margin ran out. Here's why that matters. Fear selling can last for days, because fear lingers. Forced selling ends when the positions are closed. And when forced selling ends, the pressure evaporates, the market stabilizes, and sometimes it reverses violently because all the weak hands have already been removed. So when you see a crash like this, the first question isn't, is it over? The first question is, what kind of selling is this? If it's forced selling, there's a floor. If it's fear selling, there's more pain ahead. And the only way to tell the difference is to watch the behavior after the initial cascade. Does price stabilize? Do dips get bought? Does the market hold a higher platform? Or does it keep grinding lower with weak bounces and heavy selling on every rally? That's the tell, not the headline, not the pundit, the structure. But that's not the part that matters yet. The next part is what it reveals about everyone who got liquidated. Let's pause for 1 second. If a move can wipe out thousands of traders overnight, what does that tell us? It tells us the trade was crowded. It tells us the leverage was excessive. It tells us that most of those people had no plan for this scenario. They were positioned for up. They weren't positioned for violent down then up. And the market doesn't care about your target. The market only cares about your margin. Here's the mistake most people make. They confuse volatility with failure. They see a drop and assume they were wrong. But volatility is not a verdict. Volatility is a test of position sizing, a test of time horizon, a test of how badly you need to be right today. And the market loves one type of person above all others, the person who needs certainty, because certainty is expensive, and the market sells it at the worst possible price. So we need to ask a harder question. Were those liquidated traders unlucky, or were they unprepared? Because the move didn't have to be large. It just had to be larger than their margin. And margin is a razor. It feels powerful until it cuts you, and that's where the real pressure starts. Now let's talk about what this crash actually did to the market structure, because most people only see the damage. They don't see the reset. Liquidations don't just destroy, they also clear. They remove weak hands, they reduce open interest, they reset positioning, and when positioning is reset, the next move can be more powerful. Because there's less overhead resistance. The people who were going to sell in panic have already sold. The people who were going to get liquidated have already been liquidated. What's left is the core. The holders who survived, the buyers who were waiting for exactly this kind of washout. This is why crashes often precede rallies. Not because the crash was fake. Because the crash removed the fuel for further decline. Think about it. If everyone who was over-leveraged long has already been liquidated, who's left to sell? And if the underlying thesis, industrial demand, monetary debasement, physical tightness, hasn't changed, then what's actually different after the crash? The price is lower, the conviction is higher, and the weak hands are gone. Now that doesn't mean the bottom is in. That doesn't mean you should ape into the next candle. It means you need to understand the difference between price and structure. Price can drop while structure stays tight. Price can rally while structure is deteriorating. And if you trade price without understanding structure, you'll always be one candle away from panic. So what do we watch? We watch the curve. In silver, the term structure, how near-month contracts price versus later months, tells you something about urgency. When the front of the curve is strong relative to the back, it means someone needs metal now, not later. Now, that's a sign of real demand. When the front relaxes and the curve flattens, the urgency is fading, the forced behavior is cooling, and the rally might be losing its foundation. We watch the spreads, we watch the premiums, we watch the borrowing costs, we watch how aggressively dips are being bought, we watch whether price can hold the higher platform or whether it's slowly grinding back into the old range. Those are the tells. Those are the signals that matter. Not the headline, not the Twitter guru, the structure, but that's not the part that matters yet. The next part is what the crash reveals about your own position. Here's a framework we can use. Simple, no jargon. Define the metric. Explain why it matters. Apply it. Let's do it with leverage. Leverage is borrowed exposure to amplify a bet. It matters because it makes small moves lethal. In this crash, the move didn't just change price, it triggered forced selling, which made the move bigger, which triggered more forced selling. That's the loop. And loops are how markets steal time from you. They accelerate until the fuel runs out. And if you're the fuel, you don't get to participate in what comes next. Let's do it with positioning. Positioning is the combination of cash, time, knowledge, and emotional control. It matters because it decides whether volatility is a discount or a death sentence. In this crash, the same candle destroyed gamblers and rewarded builders. Same market, same price, different position, different outcome. Let's do it with timing. Timing is not about predicting the exact bottom. Timing is about being able to act when opportunity appears. It matters because opportunity doesn't wait. In this crash, the window to buy the low 70s was measured in hours, not days. If you didn't have cash, you couldn't act. If you didn't have a plan, you hesitated. And hesitation is how you miss the move you've been waiting for. Do you see why this isn't really about silver? Silver is just the stage. The real script is human behavior. And life runs the same script. Life will liquidate you too if you overextend. If you build a lifestyle on leverage. If you build a career on borrowed confidence. If you build relationships on borrowed time. Then one storm arrives and it all snaps. The discipline that protects a portfolio also protects a future. The patience that builds wealth also builds character. That's not poetic. That's practical. And that's where the real pressure starts. Now let's talk about the psychology, because this is where most people actually get wiped. The chart is not the weapon, your own mind is. They don't need to lie to you. They just need to make you feel. They need the drop to feel personal. They need the red candle to feel like a judgment about your intelligence. They need you to interpret volatility as failure, so you sell at the worst possible moment. And if you take that bait, you do exactly what they need. You provide liquidity. You sell low. You swear off the market. You walk away right when the cycle is resetting. This is why discipline is priceless. Not because discipline makes you a robot, because discipline gives you a pre-made decision, a rule, a boundary, a line you don't cross when your emotions are screaming. Here's what discipline looks like in practice. Before the crash, you decided how much you could lose without it affecting your life. You sized accordingly. When the crash hit, you didn't negotiate with fear. You checked your position against your plan. If the plan said hold, you held. If the plan said add, you added. If the plan said cut, you cut. No drama, no second guessing, just execution. And here's what lack of discipline looks like. You sized based on hope. You levered up because you wanted bigger gains. When the crash hit, you froze. You watched your equity drain. You told yourself it would bounce. It didn't bounce. You got liquidated, and now you're angry at the market instead of angry at your own process. Same market, same crash, different outcomes. The only variable was preparation. Now here's a truth that sounds simple, but changes everything. Most people prepare only for sunshine. They buy when it feels safe. They take risk when the chart is smooth. They get confident when everyone is confident. Then a storm hits and they discover they built their house out of paper. We don't do that. We prepare for storms. We keep dry powder. We build rules when we're calm so we don't have to invent rules when we're bleeding. Because in the moment of fear, your brain is not a strategist. It's an animal. And animals run. So we need systems, not vibes, not hope. Systems. And that's where the real pressure starts. Now let's talk about the quiet winners. Not the ones posting screenshots on social media. Not the ones bragging about buying the exact bottom. The real ones. The ones who don't need to tell you because their portfolio speaks for itself. They did 3 things during this crash. First, they were sized so the volatility couldn't kill them. They could have been wrong and still survived. Second, they had cash, dry powder, reserve. So when the opportunity appeared, they could act instead of watch. Third, they had a plan, a checklist, a set of conditions that told them whether to hold, add, or cut. They didn't negotiate with fear because they had already made the decision before the fear arrived. No magic, no secret indicator, no insider information, just structure, and structure beats vibes every time. Now here's the part that will annoy some people. If you got liquidated, you were overexposed. Period. That's not an insult. That's information. And information is power if you use it. So we don't shame ourselves. We audit ourselves. We ask where we built on hope. Where we built on leverage we couldn't afford, where we built on borrowed time. And then we rebuild, stronger, boringer, safer, because safe is what lets us attack later. The goal is not to avoid all risk. The goal is to take risk you can survive being wrong about, because you will be wrong. Everyone is wrong sometime. The question is whether being wrong destroys you or just inconveniences you. And the answer to that question is determined before the trade is placed, not after. And that's where the real pressure starts. Now I want to bring this back to the market, because the crash isn't the end of the story. The crash is just a chapter. Silver proved it can trade in the $80 zone. It did the thing everyone said it couldn't do. Then it got slammed by the leverage reset. The weak hands got removed. The positioning got cleared. And now the market has a decision to make. Does it hold the higher platform, the low to mid-70s, and rebuild pressure for another push? Or does it bleed back into the old range and relax all the tension we've been tracking? That's the question, not, where is silver going tomorrow? That question is unanswerable. The real question is, what would confirm the thesis and what would weaken it? Confirmation looks like this. Price holds the 70s. Dips get bought with aggression. The curve stays tight. The urgency signals don't relax. Rebounds are supported, not immediately sold. And eventually the market takes another run at the breakout zone. With less leverage, more conviction. Weakness looks like this. Price grinds lower. With weak bounces, the curve relaxes. Urgency fades. Dips get bought hesitantly, then fail. Rallies are sold immediately, and the breakout starts to look like a trap instead of a transition. Both scenarios are possible. The market doesn't owe us confirmation. It owes us nothing. But if we watch the right signals, we can tell which scenario is developing before the crowd figures it out. And that's where the edge lives, not in prediction, in observation. So here's your checklist for the next 2 weeks. Watch whether silver can reclaim and hold the upper 70s on a closing basis. Watch how it behaves around the $70 handle. Is it a trampoline or a trapdoor? Watch the curve. Is the front month staying firm relative to the back? Watch the dips. Are they being bought aggressively or timidly? Watch your own behavior. Are you making decisions from a plan or from emotion? If the structure holds, the crash was a reset, not a reversal. If the structure breaks, the crash was a warning. And the difference between those two outcomes is worth more than any price prediction you'll ever hear. And that's where the real pressure starts. Now here's the final truth. This crash wasn't random, but it also wasn't the end. It was a message that the game is tightening, that liquidity is thin, that leverage is crowded, that the next violent move, up or down, will be even faster, and the people who survive it won't be the loudest. They'll be the most structured. So don't stare at the chart, hoping for answers. Build the rules. Fix the exposure. Strengthen the position. Keep cash. Keep patience. Keep discipline, because the next candle is already loading. And when it prints, you're either going to be positioned to capitalize, or you're going to be the liquidity someone else capitalizes on. One rule for us: survive first, then swing. The market can't reward you if you're not here tomorrow. The crash was violent. The lesson is clear. Now we see if anyone learned it.